Welcome to today's episode of MMA Municipal Bond Review. I'm your host, Lynne Ashminov from BestCashCow.com. Joining us today is Tom Doe. Tom is the founder and CEO of Municipal Market Advisors. Tom, it's great to have you with us.
It's a pleasure to be here, Lynne.
Well, the stimulus efforts have resulted in more municipal bonds that are taxable through the Build America Bond Program. Are these opportunities for investors looking for taxable investments? And can you tell us what exactly they are and what the benefit is?
Well, Build America bonds is a very interesting subject for someone like me who's in the municipal bond market. As you're correctly pointed out, these are taxable bonds, and they are able to be issued by states and municipalities through the American Reinvestment and Recovery Act, with the idea that the investments or the capital that was raised would support building of projects like paving highways or building bridges that would then create jobs. Well, this has become very popular because the reason they exist is the federal government provides a subsidy to municipal issuers of 35%, which means that they're giving money away. We're paying for those bridges and highways, so we're helping everybody out. What has happened is that the investment world has found that these are very attractive to spread municipal investments globally. They're more attractive to institutional investors who are seeking the safety of the credits of the municipal bond industry, especially sovereign-like credits like the state of Massachusetts or state of Florida, state of California. So they're attractive. So it's been mostly insurance companies, endowments, pension funds who have bought these. The individual investor, they're mostly long-term, so 30-year maturities, so a little bit longer than most individual investors want to go out. They're probably the highest yield, and they're mostly all pretty solid in credits. It's been about 6%, so after getting taxed, not overly attractive, better than Treasury, but maybe not as good as a corporate offering that might be available. So the individual investor has been a little bit wary. There is a ETF for Build America bonds. There is Eaton Vance, I believe, has a mutual fund oriented toward Build America bonds, and a few other money managers, including the taxables. What is interesting about this is that the impetus, right, for Build America bonds was to create jobs, but we were talking with the social responsible investors in Washington, D.C., and they were sharing with us that they can't invest in them because there's no definitive proof that they actually do create jobs. But the Build America bonds, the real impact for investors, and again back to the municipal investors, is that they have essentially replaced tax-exempt financing. So there's fewer. Last year in 2009, there was 5% less tax-exempt bonds available for institutional investors or individuals, and so that's also kept yields a little bit lower than most individual investors would want. So that's really been the impact of draining off tax-exempt product. And it's clearly there's an incentive in D.C., and we spend a lot of time in Washington to have the Build America bonds set a precedent or be an impetus to eliminate tax-exempt product overall. And one last note about it, which is interesting, is in 1968, Build America bonds actually were created, or the concept. And it was, here we are in Boston, one of the sponsors of it was the House Majority Leader, a guy by the name of Wilbur Mills, who was actually caught in a nightclub dancing and with we'll just leave that story as it is. But it did start 40 some odd years ago to pay for the Great Society. That was the idea of trying to get rid of tax-exempt bonds back then. So there is a history, a colorful one, for another time. But it's a interesting development in the municipal area.
Oh, very interesting. Thanks for all this great information. We look forward to future updates.
It was a pleasure.
And thank you for joining us. I'm Lynne Ashminov from BestCashCow.com. Have a great day.